The main messages of our financial stability review this time point to a period of improvement in financial stability conditions, which are connected with several factors that I will recall briefly later. And yeah, the list of the risks and vulnerabilities that we now highlight, and I want to point out that this is about risks within an horizon of the next 18 months. These are not forecasts or things that we necessarily think will materialize, and indeed these are risks, just to be understood. And there has been a change in our list of risks since our last financial stability review. Indeed, the risk that we now place in first place was in third place last time, in November. And on the other hand, there was then a fourth risk referring to funding stress conditions, possible funding stress conditions for the European banks, which is no longer there in the list because we don't see any possibility of that sort of risk emerging in the next 18 months. So the first risk that we now highlight has to do with the possibility of a reversal of risk assessment in financial markets and consequently reversal of the compressed yield, the compressed risk premia that have been prevailing and even accentuated in the past few months as a consequence of a sort of search for yield that seems to be ongoing in some financial markets. So this possibility of a reversal in these developments, which of course have been positive for European assets, is the main risk that we now highlight. And the second one is related with the bank conditions, in particular in what regards the profitability this year and in the next few years related to the consequences of a regime of low growth and low inflation. This protracted period of low nominal growth can indeed represent risks to the profitability of banks, not only in terms of lack of demand for credit to increase, but also as a result of the possibility of an increase in non-performing loans. So this risk is still something that we consider may emerge in the horizon, although the conditions for this risk have not been aggravated since our previous issue of the FSR. And finally, we also point to the possible reemergence of sovereign debt sustainability concerns, and so reemergence of stress in the sovereign debt market. A risk, nevertheless, that we now consider as very much subsided, as it is shown by the color and the direction of the arrow in our presentation of the risks. But, of course, we cannot exclude it altogether because, again, the regime of low nominal growth may raise concerns. And also, if indeed the countries and Europe in general would slow down the pace of structural reforms, which also could create some emerging doubts. So we still signal this risk, although in a much more subsided way. I will show you now some slides that illustrate these ideas about these risks. We see indeed how the financial markets have continued to compress risk premia in several asset segments, the more significant ones that you can see on the left have to do with the sovereign debt yields of the stressed countries in Europe. That's the green curve. And immediately after that comes the euro area high-yield bonds. So a typical case of a search for yield leading to this evolution of high-yield bonds. And then Germany and other countries, but you see that comparing with what has happened in other parts of the world, emerging markets or the US, this trend has not been the same. It has been specific of European assets, which also shows on the right-hand side, where you see the high yielders spread are almost at the level of the 2007. Sorry. These are then significant illustrations of those ideas. We also see in the financial markets a rotation that is ongoing, ongoing also in particular in European countries, as you see in the lower right quadrant of the chart on the left. You see that in those countries there has been a rotation from bonds to equities since May last year. Whereas in emerging markets, which are represented there by red dots, you see that there has been outflow both of bonds and equities, which is an indication of this rotation and also an indication that partly of the conditions, the favorable conditions for European assets are also connected to the outflows from emerging markets since last year, and part of that money has come to European assets in view of the disappearance of tail risks and the improvement in the fundamentals of the European countries. These trends showed increased confidence of investors in European assets and a rebalancing of their portfolios that perhaps in previous years had decreased their weight of European assets and now have turned to a more normal situation. This risk, it's important to illustrate what this risk may represent for the several types of financial institutions in Europe. And in this chart, you have the percentages in terms of total assets of each type of financial institution, the weight of different types of securities, where these possible reversal of risk assessment would lead to capital losses. And as you see, the banks themselves are the ones where this type of securities weight less in percentage of their total assets. Whereas other types of institutions, by definition, because it's their business model, like money market funds or investment funds in general, and insurance companies and pension funds are more exposed to this possible risk. It is to be highlighted, nevertheless, that in showing these simple percentages, the composition of balance sheets, we don't take any information about hedging because it's not available, so we don't know how much these different type of institutions have hedged their risks. And we hope that they have as much as they could, because this is a risk that it is has now a lot of awareness in the market. So it's normal that everyone is aware of this possibility and what they have to do to protect the resilience of their balance sheets. Regarding the weak conditions of profitability in European banks and possible problems going forward, as we all know, in particular since last year, but also started a little bit earlier, banks have been increasing their provisions, recognizing impaired assets and increasing impairment costs. And that, of course, has led to lower profitability as a result. And it is interesting to then to compare on the chart, in the chart on the left, the return on assets of European banks and global banks of the same type, with and without the provisions. And as you see on the left-hand side, if we just consider return on assets without provision costs, then the return on assets of European banks is rather similar to global banks. But then, if you, as you have to, if you consider the provision costs, the recognition of impairments, then the picture changes, and the European banks show a much lower return on assets. So, which is important to recognize, because it means that if indeed this is part of a temporary correction of the balance sheets of the European banks, as of course we believe they are now cleaning up their balance sheets, it means that after that process is completed, and it will be completed after the comprehensive assessment, it means that profitability of European banks will go up as a consequence. All other things being equal, as economists like to say. And you see indeed in the chart on the right that the provision costs are more or less stabilizing, and even in different types of institutions, in particular in the large complex banking groups in Europe, the curves to the right. So it is important to understand this aspect of profitability developments, although, as I mentioned before, one of the risks, the second one that we highlight in this FSR, is indeed the risk that a regime of low inflation and low growth can affect negatively, or continue to affect negatively, profitabilities of the European banks. The robustness or solvency picture of the European banks has indeed improved a lot since 2011, that we show in this chart, with a core tier 1 ratio of 9.7 in 2011 to 12.1% in 2013. That's a significant improvement, and as you see there in the smaller columns, this was the result of capital increases, meaning quoted shares issued by the banks, and also these red bar there during 2013 has to do with the contribution of the deleveraging which occurred in the European banks' balance sheets. So the balance sheets really shrunk, and that has improved, of course, the capital ratio. There was a big deleveraging occurring during 2013. A very important part, almost half of that deleveraging, was in the derivatives book. It's important to highlight that. It was not the result of big asset sales or even less big decreases in credit. It was the result of the derivatives book being compressed. It happened, by the way, to all international big banks, not just the European ones, this movement. The banks worldwide, the big banks anticipating, I presume, the coming leverage ratio, have indeed decided to settle the derivatives that were on the money in order to compress their balance sheets. So that's what's happened. But nevertheless, it's a remarkable improvement that we highlight in the FSR. And also we highlight that the strengthening of the balance sheets of European banks since July last year in different ways and forms is quite significant to the tune of numbers around 100 billion euros, either as a result of equity issuance, real equity issuance, or one-off extraordinary provisions, above what would be the normal path of provisions, and issuance of hybrid contingent capital instruments, and so on. So there has been a lot of front-loading by the banks preparing to the comprehensive assessment and preparing to finalize the repair of their balance sheets. So, regarding the third risk, just two charts to illustrate. On the left, the improvement that has been implemented by various countries in the fundamental conditions of public finance. So reductions of deficits, slight decreases of debt ratios, and although they are still many in a situation that has to continue to be corrected, nevertheless, this improvement in fundamentals, and I would say added to the improvement in the external accounts of all stressed countries and a return to growth, were good fundamental reasons why the appetite for European assets has increased. On the right, I show the domestic sovereign bond holdings of total banking sectors in Europe for you to have an idea of what it means. And indeed, if we take the normal countries that have been under stress, we have Italy with 10.3% of total assets of the banking sector in Italy invested in domestic government bonds, 9.7 for Spain, 7.4 for Portugal, which is not there, 3.8 for Greece only, and for the euro area, 5.5% only. And then you have Slovakia, Japan, United States, and Slovenia is also there with a higher figure. And let me underline that the figure for the United States include the bonds of Fannie Mae and Freddie Mac, as they are now they have been assumed as part of public debt in the US. So this is the picture and what it can mean. And as you know, in the comprehensive assessment and the stress test, we have stressed the sovereign debt instruments. So, to sum up, very briefly, I would say that there has been an improvement in the financial stability conditions of the euro area. The stress on banks has eased in the past few months, and they have strengthened their balance sheets in preparation for the comprehensive assessment. So we can say with confidence that the comprehensive assessment will complete the repair of the bank's balance sheet. This means that after the comprehensive assessment and the implementation of the follow-up measures, the credit supply restrictions will be eliminated in Europe. Credit supply restrictions. Of course, the flow of credit will continue to depend on the demand for credit and on the proper credit risk assessment by the banks. So what I am referring to is that the cleanup of balance sheets puts the banks into a condition not to have to restrict credit for reasons of their own weakness. And that's what is important in the comprehensive assessment, as this means that for next year, banks will be much better prepared to finance the economic recovery in Europe. And that's a very important condition for the sustainability and consolidation of that recovery. But this means that the banking union and the comprehensive assessment are dealing with the legacy of problems for the banking sector. But new risks exist, have emerged, in particular the two first ones I mentioned, the possibility of a reversal in the search for yield and with the consequences for financial markets and for financial institutions, and also the problem of weak demand and low inflation that, if it continues, can really hinder the recovery. So these are risks that we are very much monitoring and alert, and in what regards other responsibilities of the ECB, we are dealing with them as much as we can. Thank you. So I am now
Thank you very much.
Ready for your questions, please.
John? Wait for the microphone. Please identify yourself.
John O'Donnell from Reuters.
Yep.
You talked also in your report about the fact that investors don't appear to be recognizing risks. What risks are there for those investors of ignoring the dangers, perhaps, of this current market environment? And what measures would you like to see them take?
Well, we don't have advice to give to investors, as you know. But of course, we see these developments. These developments are, in many ways, justified because, indeed, fundamentals in Europe have improved. Everything in finance is relative. And as there were outflows from emerging markets for reasons that had to do with the turbulence there, it was normal that part of those outflows would come to Europe. So it's part of these adjustments. And also, it's a normalization of the situation because in previous years, many investors around the world have decreased the weight of European assets in their portfolios. So now in the new situation, it is normal that there is this normalization, and these have a temporary effect, which of course will tend to subside. Either the outflows of the emerging markets are not increasing anymore, the rebalancing of portfolios may be about to be concluded. But these are good explanations for these developments, which were favorable, of course, for European assets. And now, financial institutions in particular have to be prepared to face any possible reversal of these. And they know how to do it. And in what regard banks, after November, the ECB/SSM will be in charge of supervising how they really deal with the robustness of their balance sheets.
Thank you. Next question. Yes, please.
Just to be sure to
Yes.
You see a risk in the abrupt reversal of the global search for yield. Could you maybe give us some concrete examples?
Examples or why triggers for this reversal? Yes.
In which way could this risk materialize?
Yes. Well, there are several points. There are, first, geopolitical risks nearby Europe. I mean, I'm referring, of course, to the situation in Ukraine and Russia. We don't know how this will develop. It's a possible risk that, of course, if it would aggravate, it would create a cloud over European assets. So we highlight this possible trigger in the FSR. Then there is the possibility of a change, a fundamental change, in the monetary policy in the US. We don't know if it happens and what effect it will have exactly. We saw last year when in May the Fed announced the possibility of starting tapering, meaning reducing the asset purchases, it had a big impact all over the world, also in Europe, in yields, medium-term yields, and so on. So that then the markets understood and absorbed and discounted. So the actual tapering had no effect. And the outflows from the emerging markets by the end of the year were more related to the situation and vulnerabilities of the countries themselves, more than a direct result of the tapering that was going on. But we never know how this can go, and it's no longer about tapering, but it's about more fundamental change in policies. By the way, in July last year, we introduced our forward guidance, which was quite successful in reducing the contagion effect that the announcement in May had in European yields. But that's certainly one risk that is out there. Then the situation in important emerging markets may decelerate more than is the baseline scenario. And that again, if indeed emerging markets would decelerate significantly, that could trigger some reassessment of risks in the world economy.